If you own property, invest in property, or you aspire to get on the housing ladder, this video is one you cannot afford to miss, because over this year we've had a tidal wave of changes. Stamp duty increasing, skewing the market. The Renters' Rights Bill, which comes into law September at the earliest. Mortgage interest rates, as you can see, staying pretty flat. And big corporate landlords, the BlackRocks of this world, buying up what feels like absolutely everything. So if you don't know me, I'm Will Gale. I've spent the last 13 years building two national property businesses, British Home Buyers, a UK-wide home buying company, and British Home Sellers, a nationwide estate agency. And across those businesses, me and my great team have dealt with over 14,000 transactions, totaling in and around £5 billion. And I've never seen a shake-up like what's happening right now. There is more property on the market now than there has been for over a decade. There's a reason for that. So today, let me break down the 9 key changes to the UK property market clearly, calmly, and importantly with the data to back it up. So let's talk about why, number 1, asking prices are now falling. Rightmove's latest report shows asking prices fell 0.3% in June, when they normally rise in the summer. You can see from this graph that the back end of last year, asking prices fell most months, then have really boosted over the start of this year. Now, why is that? Because Labour confirmed towards the end of 2024 last year that stamp duty rates would rise the end of March of this year. So that front-loaded the year with people rushing to purchase before the increase, which artificially boosted the market. The way to think about it is stamp duty increasing created a surge in demand of people ironically trying to save money by beating the increase. Look at this graph and you can see how it created a massive surge. And you can see this is the same thing that happens time and time again when stamp duty has changed in the past. So this was, of course, completely predictable to everyone involved. But what happens when you have a surge of demand? Prices, of course, increase. Ironically, people trying to save on stamp duty, in some cases, may have overpaid for their properties than if they bought those same properties now once demand has fallen back. Now, asking prices falling isn't affecting the entire of the UK equally. You can see from this map that generally the south is suffering, where house prices have been stretching against affordability at the point of breaking point. Whereas up north, opportunity is growing purely because asset prices are lower. There is more room for growth provided the jobs are there. So it's becoming more enticing for people to move out of London into other major business hubs where offices are cheaper, homes are cheaper, the cost of living is cheaper. So in reality, the headline of average asking prices dropping is of course true, but really the UK property market is a story of two halves, the half suffering and the half thriving. But despite this, let me explain how both halves of the property market still have some pain to bear. 2, property supply is surging. Take a look at this graph. There is more property on the market now than there has been for over a decade. And that is a problem because although buyer demand has increased 7%, and although the number of sales agreed has increased 6%, which is great, the flow of new supply coming to the market has increased 8%. And so the glut of property on the market is 14% higher now than a year ago. So yes, demand is increasing, which is great, but supply is increasing at a faster rate. The result is there is a clear link between a high supply of homes for sale linked to lower house price growth. But again, the UK property market is a story of two halves. You can see from this graph there is a trend. Areas like London, the southwest, southeast, that are seeing 16 to 19% more homes on the market today compared to the same time last year, are seeing the lowest levels of house price growth, not even growing 0.5% nominally. So if you adjust for inflation, they are clearly going backwards. But in contrast, the north of England, West Midlands, Scotland, they've seen only a small percentage increase of properties coming onto the market, up 2 to 3%. And as a result, house prices are increasing more modestly, 2 to 3%. But again, bear in mind, if you adjust for inflation, these growths are pretty flat. So let's talk about the bigger problem of 3. Why is supply of property surging? Well, in 2020, the average mortgage rate was 2.4%. Today, it stands at 4.77% for a 5-year fixed mortgage and 4.98% for a 2-year fixed mortgage. So can you see the problem? 1.8 million of these low-interest mortgages are set to expire this year alone. The average homeowner will see their mortgage payments rise 31%. So clearly, this is triggering a larger than usual portion of homeowners that want or worse need to sell to reduce their debt burden, reduce their monthly repayments. Now, of course, this won't matter to those of you that own a property and don't have a mortgage or have a very small mortgage. It's clear from this image that debt is overwhelmingly on the shoulders of younger generations. This graph shows the extent of that problem. The over 65s own 62% of property, but only 4.9% of mortgages. Those up to the age of 44, they own 15% of the property, but 78% of the mortgages. Just think about this for a moment. So when the over 65s that own 62% of properties start to need to sell or downsize, or sell sadly because eventually they'll pass away, who's going to buy all these properties? You can already see an oversupply of property is already holding back house prices right now. Right now, this is being caused by interest rates, but at some point in the future, this same problem will be created by an aging population needing to sell. Just take a look at Japan. So let's talk about a solution I think feeds this problem. Number 4, the danger of 90 to 100% mortgages. 100% mortgages are back, aimed at first-time buyers, but what it really means is more liquidity flooding the system, which props up house prices. It's sold as helping first-time buyers, but in reality, it completes property chains to justify property values as you work up the housing ladder. So if someone is trying to upsize, they can't do that unless someone is at the bottom of the chain buying a property. It's almost like a pyramid of debt. You need people at the bottom to come in to buy up the lower end of the market so that those above can edge their way up and up and up, can work their way up the property ladder. And this fuels the higher purchase prices up at the top. If you lose the bottom of the market, the whole house of cards is at risk. But let's step back for a moment and imagine this. What if for the past 50 years the rules were different? You could only borrow 2 times your household income. You need a minimum 25% deposit. And investors and corporations paid, let's say, a 10% stamp duty surcharge. We'd still have the same housing shortage, the same race to get onto the housing ladder, and the same emotional weight tied to owning a home. But the key difference, not only would everyone have more expendable income to spend on goods and services that grow the economy, not trap it in housing debt, unproductive housing debt, but also with less money in the system directed at property, house prices would be lower. It wouldn't mean it'd be easier to buy, it would just be cheaper and leave more money for other aspects of the economy. Because house prices don't just reflect supply and demand, they reflect how much money is chasing that supply. That's why when banks relax lending criteria, when governments offer help to buy or 100% mortgages, when interest rates fall or QE pumps trillions of pounds into the economy, it adds fuel to the market, not more homes, just more money chasing those same homes. That's why your parents could buy a 3-bed semi-detached on 1 income, and why today even 2 professionals struggle despite earning far more. Liquidity inflates prices, but it doesn't ease the pressure or fix the underlying system. It just makes it look like we're doing something, while in reality kicking the problem further down the road. But what if you rent? It's great to have more supply for people to buy, But what if people need to rent? 5, the buy-to-let exodus accelerates landlords. Landlords are leaving and in reality being replaced, and it is the changing of the guard in the form of corporate landlords buying up billions in UK property and smaller investors exiting. Right now, 18% of all homes on the market today are former rental properties. Why? Well, a big reason is higher interest rates, of course, but also because when the Renters' Rights Bill comes into force, it just adds more red tape. Section 21 no-fault evictions are being abolished, so it's going to make it really hard to get rid of bad tenants. Rent increases can now be rejected and delayed by tribunal, and you can no longer automatically increase rent via tenancy agreements. So it's artificially constraining the sort of free market of rental. This means less control, more delay and high risk for landlords, and it's pushing many, generally smaller investors to sell up, while corporate landlords move in. Yes, and I of course know if you're not a property investor, some of you will be thinking this is great news. I appreciate the buy-to-let boom was not generally helpful to society over the Tony Blair and Gordon Brown days. But the challenge here is you now have an oversaturation of buy-to-lets hitting the market that is making it, yes, easier for first-time buyers to buy that can afford to buy, which is great, but it's also been pushing up rental prices through the roof because there is far less supply for those that need to rent. And who do you think is swooping in to save the day? Number 6, corporate landlord ownership hits new highs. So if regular buy-to-let investors are losing, who is winning? Well, big players like BlackRock, Lloyds and Legal & General literally buying up the country. These aren't just landlords, they're building empires with the aim of locking in more and more of us into lifelong renters, expanding their customer base in a way. BlackRock is on an asset buying spree at buying up undervalued UK property. Lloyds Bank has been declaring since 2021 that it wants to become the UK's largest landlord. They're snapping up houses often directly from developers in bulk, entire blocks, never even listed online. And they get discounts, economies of scale and government incentives, like for example paying commercial stamp duty rates rather than residential rates you and I would pay. The right part of this image is commercial rates, so they pay 5%, whereas the left is standard rates, and you can see an investor will pay 5% higher rate on top of standard stamp duty rates. Why? How is it fair that corporates get this advantage? Why is no one talking about this? BlackRock is even buying into brick manufacturers, literally controlling the building blocks of UK housing. They're even buying up railway arches. Who would have thought? More than 5,000 of them that have the scope of being developed underneath as commercial space. So you have to understand these big corporates, they're not just buying houses, they're buying the system, which then influences and molds how the property market develops over time, how the rules of the game are set. Ultimately, the price on home ownership. And they love property because property equals inflation-proof cash flow. Rents are soaring up 15% nationwide over the last 2 years. Corporate landlords armed with billions of pounds in low-cost financing can afford to weather policy changes that are squeezing all these smaller landlords out, squeezing out their competition. And the result, a shift towards an American-style corporate rental market, where ordinary families rent long-term from huge institutions. And once the corporate players take over, it's hard to see things ever shifting back. But let's go back to who is actually buying up homes to live in right now. Is it first-time buyers? 7, who's actually moving right now? Forget the first-time buyer narrative. There is a reason why 100% mortgages are coming back for the first-time buyers and the like. The real movers in 2025 at the moment are pensioners. They now make up 25% of home movers, up 17%. Those over the age of 45, excluding pensioners, account for 42% of all home movers. Households earning over £1,000 now equate to 31% of all movers. So you can see a big portion of the property market is being fueled by those with generally higher incomes and more wealth. And of course, they're moving into sort of larger homes, 4-5 bed. Home demand is up 7%. So detached and semi-detached homes are in hot demand, whereas terraced homes and flat sales are declining. And most of the demand is heading towards accessible rural areas, away from hyper-urban areas, but also away from super remote rural locations that became popular over COVID. The market right now is actually being driven by affluent older buyers looking for space and lifestyle. That is what is skewing the averages with everything right now. So is it starting to click why 100% mortgages are back for first-time buyers? It ironically isn't going to benefit them. It's going to fuel all those transactions further up the chain, helping them release equity and wealth while simultaneously loading those at the bottom of the housing ladder with enormous amounts of debt to keep this pyramid up. Exactly at a time when the housing market has been struggling to grow ahead of inflation. Some of these buyers could fall victim to the winner's curse. Take a look at this graph. That shows average house prices adjusted for inflation over the last 35 years. Look how they grew and grew and grew over the 90s up to the 07 crash. This is why most have it in their heads property prices double every 10 years. But look how they have never recovered adjusted for inflation since the 07 crash. Look how over 2022 they crashed 16% when adjusted for inflation. This links nicely to a really important point. 8, inflation is hiding the truth. So let's quickly break this graph down, because understanding this graph might change how you see every headline around inflation, especially when it comes to property. CPI, the Consumer Price Index, that light blue line, is the headline rate of inflation you see on the news. As of May, it's at 3.4%. It measures the average change in prices for goods and services. So things like food, fuel, transport and clothing. But here's the problem. It doesn't include the cost of owning and living in a home, which, let's be honest, that's the single biggest expense for most people have, other than maybe nursery fees if you have kids. That's where CPIH comes in, the darker blue line. It's 4% as of May. H stands for housing and includes a measure called OOH, Owners, Occupiers, Housing Costs, that black line on the graph sitting at an incredible 6.7%. This is an attempt to capture what it feels like to own a home by estimating how much you'd have to pay in rent for a similar property that you live in. But even CPIH doesn't track actual house prices or mortgage payments. Instead, it uses something called imputed rent. Basically what you might pay to rent the home you already own. It's a soft estimate, not a reflection of real mortgage costs or deposit hurdles. So if we look at OOH, only occupies housing cost by itself, that black line, is sitting at 6.7%. This inflation measure isolates just those housing costs, so maintenance, stamp duty, insurance, and again this imputed rent. But none of these actually include house prices or mortgage rates directly. So when interest rates go up and your mortgage suddenly doubles, that's not showing in CPI inflation. So when the Bank of England says inflation is under control at 2.3% or 3.4% or whatever the figure is at that moment, it's rubbish. What they really mean is food and clothes have stopped rising as quickly, but your cost of living, if you're buying a home, may still be going through the roof. Owner-occupiers housing inflation is at 6.7%, for goodness sake. It is housing costs that are killing our standard of living. Nigel Farage in Reform UK. Love him or hate him, Nigel Farage's Reform UK has surged ahead of Labour in recent polls. Farage himself holds a multi-million pound property portfolio. Reform's chairman, Richard Tice, runs a £500 million property investment firm. So what could a Reform government mean? Maybe a potential rollback of anti-landlord legislation, maybe more landlord-friendly policies to revitalise buy-to-let investing, Maybe a new wave of pro-property economic stimulus? Who knows? But until the election, latest August 2029, we have what we have. Comment below with what you think about all this. I genuinely love the comments you leave, and I reply to each and every one of them. I learned a lot from your comments. And at the very least, like or subscribe, as it helps me grow this channel. I'll see you in the next video up here.